Okay, welcome to Wednesday. It's a Wednesday all day. I'm going to dive right into to equity. So we spent the last 4 class periods talking about debt securities, bonds. We're going to talk for probably the next 2 periods, maybe going Monday, on stocks. Again, what you're going to find is in finance, this constant theme comes back of we're looking at expected future cash flows discounted at an interest rate or a discount rate which reflects the risk associated with the asset, and that determines the theoretical price. Stocks, bonds, a piece of equipment, any financial asset tends to be valued exactly the same way. So once you get that concept down, it then just becomes little tweaks around the various types of financial assets so that you can model them correctly. Stocks, the reason why we move through stocks so quickly is because a lot of the foundational work has already been done when we talked about bonds. And a lot of it now becomes, okay, we've got a couple different components as it relates to equity, but the calculations and the theory behind it from a pricing perspective and from a risk perspective are very similar. So we're going to talk a little bit about stock. There's 2 different types, preferred stock and common stock. Anybody want to tell me what common stock is? Stock for the common man. Yes, ma'am.
Preferred, they get dividends first.
Preferred gets dividends first, common gets dividends if declared and if there's any left.
And preferred's like rollover, right? They have like a specific amount of
potentially. So common stock, kind of coming back to this common stock question, common stock is the base equity security. It is what, when you think about I own stock in Apple or I own stock in General Motors, it's generally common stock that you own. Common stock has some characteristics. When we talk about that waterfall, common stock's at the bottom of the waterfall. It's the pool into which all excess water flows. And so common stock gets to share because everywhere else up the waterfall, the pool of money that is allowed to stay at that level is defined. It's limited. It's contractually defined. At the bottom, everything else cascades all the way to the bottom, and whatever's left at the bottom, if there's nothing or if there's a gusher, that all goes to common stock. Common stockholders generally have the ability to vote. You have the ability to elect the board of directors. The board of directors then elects the corporate officers. You have the ability to approve mergers and acquisitions. You have the ability to sell or not sell the common stock. You have the ability to change the corporate bylaws. You have control rests with the common stock. But with that control comes a higher level of risk because everybody else gets paid before you see it done. And the only time you're entitled to a share of the profits, so let's say a company makes $1 billion in profit, the common stock only gets to get that in cash, and again, we're in finance class, so we're concerned about cash, if the board of directors declares a dividend. If they don't, the cash stays in the business. So common stock has all the upside, all the downside, and has, in theory, the control over the organization. Preferred stock, it's called a hybrid security because it has characteristics similar to both debt and equity. You can see that it's similar to bonds in that contractually, when you buy a preferred stock, it says it's going to be a 7% preferred and it's issued at $100 par. So that sounds like a bond, right? $100 par, 7%, that looks like a bond. Sounds like a bond. Except you may not see the dividends because they need to be declared. And what was alluded to earlier was if the dividends aren't declared, they may be accumulating. So preferred stock may sit and go, okay, well, we didn't pay that $7 this year, so we owe that. And it doesn't, common stock can't get paid as long as there's accumulating preferred dividends. So you can't declare a dividend here if you haven't paid out all your dividends here generally. There's no specified maturity date usually on preferred stock, although sometimes there will be a call date. So sometimes when preferred stock's issued, there's going to be a call date on it. So this sounds in a lot of ways like a bond. You've got call dates, you've got regular or scheduled payments, you've got a maturity or an issue value, a par value. And generally, you price it similar to a bond, but you don't have a fixed maturity generally. And then again, common stock is that which rules everything as long as there's money left over. As is usual, we're going to talk about some of the definitions, because as you go through this stuff, the definitions, as you're working word problems and you're working reality, the definitions tend to be where the problems are. It's not the math. You just need to know what the definition means and where to drop stuff in formulas. So par value, it's called this says it's a nominal or face value of a stock or bond. We talked about bonds and par value, or bonds and maturity value, or bonds or issue value. Par value for stocks is a little bit different. We just talked a little bit about preferred stock. Who could recap that? What's the par value on preferred stock? Oh, it's going to be a long Wednesday.
Is the price out of the market?
It's the price that it's issued at. So like a bond, the par value on preferred stock is the price that it's issued at. It might be par $25, 5%, $25. Who wants to guess what the par value on common stock is? Could be a penny. What does it mean? For common stock, what is par value?
That's the money that the corporation has to have in cash to be able to pay. Basically, buy back all the stock.
No, but you're close. You were on the right track, and then you added to buy back all the stock. Yes, sir.
The value in equity divided by the number of shares is the par value.
That's the book value. Not quite. Par value on common stock is a legal term. It's essentially the amount of cash or the amount of assets the company needs to legally have in order to be able to function as a business. So a lot of common stock is issued at 1 cent par value, which means, if the company issues 1 million shares, the company needs to have $10,000 of total assets in order to be able to function. However, back about 75, 80 years ago, a trend came out where they said, well, this is just a stupid legal fiction because we're putting a penny, or we're putting a quarter of a penny, or we're putting, some fraction of a cent down for par value because we want to maintain flexibility. So most states changed all their laws, which says you can issue no par value stock. So what you find in common stock, when you see common stock and you see par value, for the purposes of finance, it means almost nothing. It generally means zip, squat, zero, zilch. If it's common stock par value and you see that in a problem, unless you're in a business law class and you're talking securities law, it probably means nothing for us in here. If you see preferred stock and you see par value, it's important. So don't get confused between the two, because par value for common stock is not really meaningful for the purposes of finance. It's meaningful for the purposes of business law, and even there, it's becoming like a dinosaur, and it is no longer used very often. Maturity. We talked about maturity. Generally, as I had noted, preferred stock has no maturity date. However, most preferred stock issues are put with a call date because the company wants to be able to pull this money back in or pull that debt back in. Why do you think they would put a call date on a preferred stock? I just said they want to pull it back in. Why would they want to pull that preferred stock back in? Because of the mandated dividends. Why do you think they might have issued preferred stock to begin with? You have bonds, and then you have preferred stock, and then common stock. Yeah, raise capital. But why would you choose to pick this neither fish nor fowl hybrid security? Why would you issue it?
You want so for bonds, because they would be more attractive than bonds. So they're more flexible than bonds, and you can charge more than common stock.
It's more desirable than zero coupon bonds. With preferred stock, you have to pay the dividend, but you can wait years to do it.
Right.
If you need to.
So you guys just hit on it. When companies issue preferred stock, generally they're in a position where they're like, okay, we can't issue more debt because debt. Can you choose to not pay the interest payments? No, you're going to end up in default. With preferred stock, you don't have to pay the dividends. You can wait for them to be declared. And so the company goes, okay, we're a little bit shaky here. So we don't want to issue more debt. We want the flexibility, cash flow flexibility that preferred stock provides. But folks who are going to give us some money want some more security than common stock is going to offer. So they want at least some guarantee or partial guarantee of a return. They want to make sure they get their money out before the common stockholders. We might not necessarily want to share all the upside with them. And so what we're going to do is issue this preferred stock because we can't issue more debt. We need the flexibility. Financially, we might not be in a position from a credit perspective to be able to get additional debt. But we can't or don't want to issue preferred stock where folks don't want to buy common stock, or folks don't want to buy our common stock. When their situation improves and they're able to issue more debt, generally they'll want to redeem this preferred stock because generally the dividends here are not tax deductible. And you end up paying a higher percent on preferred stock than you would for comparable debt, because this is further down the waterfall. And so when a company's position gets better, they're going to want to redeem or call this back in and refinance it generally with debt. As we talked about, there's the waterfall. These have priority over common stock, but they have priority over common stock. They have priority after debt. So in the capital stack, they sit almost at the bottom. The only thing below them is generally going to be common stock. The other thing that you will find is some companies issue preferred stock Series A, preferred stock Series B, preferred stock Series C. And so within preferred stock, there's a rank order of how they get the priority for payments. Normally, preferred stock doesn't get to vote. However, sometimes preferred stock gets to vote if you haven't been paying the dividends. So we talked about, cumulative dividends, and I think that's coming here in a minute. We talked about cumulative dividends. Some preferred stock has voting rights if dividends accumulate to a certain level, because essentially what you're now doing is going, okay, we're not demonstrating the ability to be able to pay you guys, and therefore the common or the preferred stock starts to get voting rights. Convertibility. Why do you think convertibility, which is being able to turn preferred stock into common stock, Why do you think convertibility might be important to someone who is investing in preferred stock? There's note here, it says at the option of the investor. Why do you think convertibility might be an attractive option?
You can get all their guaranteed dividends now and then get rid of their stock rate.
Kind of, sort of. We talked about convertible bonds. Why would you want convertible preferred stock if you were an investor? Yeah, what kind of, so we just talked about this, what kind of companies issue preferred stock?
Companies that aren't in a position to acquire more debt, but don't want or issue more common stock.
So they're companies that are kind of in a question mark point in their life, right? They might be going up, they might be going down, they might be going to the moon, they might be going into the toilet. We're not quite sure where the company's going to go. So why might convertibility be important? If you're the investor. Because they're going up. Because the company is, when they issued the preferred stock, there was a question mark as to what was going to happen with the company. The company protects itself by going, okay, I want to put a call in here. Because if we start going up, I want to be able to pull this back in and refinance it. The investor says, I want to put a conversion feature, a convertibility feature in, so that way, if you start going up, I want to turn it into common stock and go on the upside. I want to be able to participate, just like a bond. So this preferred stock stuff looks and smells and acts like a bond most of the time. And amazingly, when we go to look at how do you price it, it prices like a bond most of the time. We talked call provisions. We've talked about sinking funds. This is all the same stuff from bonds, right? Call provision. They can bring it back in, normally at a premium. Sinking funds. They have to set money aside and essentially repurchase and retire chunks of the preferred stock in the open market. So unlike a bond where there's a maturity date, and the sinking fund may either be repurchasing those bonds on the open market and retiring them on an annual basis, or putting it into literally a fund or a separate account that at maturity is used to then pay off the bonds. Because preferred stock does not have a maturity date, the sinking fund is used to periodically purchase back all of the securities as the sinking fund is funded. And then there's these participating preferred stock, which allows distribution of the firm's earnings. This isn't what you're going to find in a public company. Where you find participating preferred stock is going to be in venture capital and in private equity in my own home. Why do you think that you have why do you think venture capital companies tend to be loaded up with preferred stock? And why do you think it's participating?
Is it to come in low, sell high?
Part of it's a come in low, sell high. Who's giving the money? If you're in a venture capital firm, you're giving money to these tiny little startups, right? And these things are either going to go to the moon, like 2 to 5% of them are going to take off. 20 to 30% of them are going to, you might get your money back, and the rest of them you're going to lose. Most of the time, for those of you who want to be tech entrepreneurs, want to go work in Silicon Valley, raise money from all the tech yahoos, they issue preferred stock. Normally, they'll buy into your company and they'll go, we're going to buy convertible preferred stock. Because if your company goes under, they're getting the money before you are. And it's convertible because if it goes to the moon, they're going to convert it. They're going to dilute you. You're going to own now a small fraction of the company. They're going to own a bigger fraction. And they're going to win. And if there's a bunch of earnings that starts getting distributed, they're going to participate as if they're common stock, even though they haven't converted. So this participating feature allows them to actually get the benefits of common stock for dividends and other things, but not convert so that they don't lose their preference in the event of liquidation. Anybody here like want to be a tech super guru, whatever, entrepreneur, go start up some computer company or software company or okay. If you ever do, or you ever work for someone, or you hear one of your buddies say that they want to go get venture capital money, don't swing by my office before they go, because they always win before you win. And they use preferred stock to do it. Preferred stock is the preferred investment vehicle for venture capital and private equity firms. And they generally have everything that you see here, except for call features, they've got. They have accumulating dividends, they have preferred returns, they have sinking fund requirements, they have participation, they have liquidation preference, they've got all of it. Because they're going to make sure that they get their money before you ever see a dime. Any questions on preferred stock? Up until 20 years ago, preferred stock was one of these things that was really popular back, in the 20s, 30s, and 40s, and then kind of disappeared. 20 years ago, it came roaring back around 1999, 2000 because of venture capital. So it's now become relevant again. Unfortunately, the way the book and the way general finance stuff talks about preferred stock is in the stodgy, it looks like a bond, smells like a bond, acts like a bond stuff. The way you'll normally run into it, what the rest of us will run into it, is going to be in those other situations where it's being utilized to really protect an investment, provide a lot of upside and limit the downside. And it's being used by sophisticated investors like private equity firms and venture capital funds. Any questions on preferred stuff before we push into Tom? Okay. How many folks here own common stock? Couple. How many of you want to? One. The rest of y'all better get on board. If you don't own stock, you're probably at some point, as you begin to move up through your career, this is your primary vehicle, either owned directly or through mutual funds, for things like 401ks, 403bs, which are your retirement funds, IRAs. The pension funds, if you go to work for the state, are invested in common stocks, bonds, and other things. So almost everybody that you know has investments in common stocks, whether you know it or not. If you have an IRA, if you have a 401k, if you've worked for a company where you've got a pension, if you've worked for the state, it's likely invested somewhere here. Common stock is where, like I said, most of the control of companies are, and that's where the ownership is. Par value, as we talked about it, legally represents a stockholder's minimum financial obligation in the event a corporation is liquidated. It's the amount you can lose. Once you go below par value, game over. Like I said, for finance, it's a fiction. You don't need to worry about par value. It only serves to confuse. So when you see common stock and you see par value, you can pretty well flush it, unless it's a multiple choice question on the quiz, which says, in which case, choose this as your answer. Dividends. What are dividends? A payment. Payment of what? Money.
Your profits in the company.
Generally, profits in the company. Yes, it's payments of retained earnings. And I say retained earnings deliberately. We'll talk about that in a minute. Of generally cash. And I say generally because there's stock dividends as well, and we'll look at those. To common stockholders, or in the last case, the preferred stockholders. The important thing to remember is companies have no legal obligation to pay dividend, ever. That includes preferred stock. They have no legal obligation to pay it. However, common stock may not get paid if the preferred dividends aren't paid because they are accumulating. But there's no legal obligation. They have to be declared by the board, and they can only be paid out if there's positive retained earnings. If there's negative retained earnings, you can have a loss in a given year and pay dividends, as long as you have enough retained earnings. When you look at a balance sheet, if retained earnings goes negative, you can't pay dividends. Preferred dividends, common dividends, cannot pay them.
You find dividends in the balance sheet, right?
You find dividends will be found generally in the statement of cash flows, in the reconciliation of equity. You may see dividends payable on the balance sheet if they've been declared but not paid as a liability. But normally you don't see dividends as a separate line item in the equity section of the balance sheet. They're deducted from retained earnings at the time of which they're declared. At the time of which they're declared, they then become a liability. And they move from retained earnings into debt as a liability. So you see dividends payable.
Once they declare it, can they call it back?
Oh, that's a good question.
I was just kidding, I don't want that dividend.
Technically, yes, you can undeclare a dividend. However, you open yourself up to a lawsuit, but that's okay. And when might you undeclare a dividend? Yeah, you're on the right track. So you're good. Yeah.
Would it be if you declare it and then like you're waiting to pay it and then for some reason your company turns?
Yes.
This money?
Yes. Subsequent event. So how many accountants I got here? I know I got a bunch of you. Okay, one of the most important things that you'll do as an accountant, one of the things that will trip you up on your audits when you're auditing is subsequent events. So what happens is you audit, you'll see this audit report that says, as of June 30th, Moss Adams and Company certifies that the financial statements of St. Martin's University are true and correct and complete in all cases comply with GAAP and blah, blah, blah. And there has been no subsequent events that materially impact the financial statements. One of the things that's important as an accountant is that you're not looking only at, okay, it's June 30th, I'm auditing those financial statements and stuff prior to that, the activity prior to that, but you have to look at subsequent events, which are events that occurred between the cutoff date of your financials that you're auditing and the date that you issue your opinion. And during that period of time, stuff can happen really quickly. You can have a lawsuit hit. You can get hit with a fine. The one that popped in my mind was Enron, but that was because that was one of my large clients at the time. And so you can have this situation where all of a sudden the company blows up. Stuff goes horribly wrong really quickly. 2008 financial crisis. Bear Stearns went from one of the largest investment banks in the country to bankrupt in 30 days. And so just like that, you can have a subsequent event. If Bear Stearns paid a dividend when they were bankrupt, or when they knew they were bankrupt, they're going to get sued by the other creditors. And so you undeclare the dividend at that point. You preserve the cash for credit. You're required to preserve cash. So if you have a subsequent event, you can essentially pull back dividends. You can do other things to try and preserve the liquidity of the company. And essentially, as a manager, you're required at that point, if you know the company's insolvent, to try and work for the benefit of the creditors. So again, no obligation to pay dividends. They become a liability, at which point they are declared. They can be undeclared by the board, very rare, generally driven by a subsequent event. Great question. Maturity. It says generally there's no maturity date on common stock. I've yet to find common stock with a maturity date. So as noted, on the waterfall, when you picture this waterfall, and at the top are your mortgage holders and senior secured bonds, all the way down to subordinated, your debentures, your subordinated debentures, your preferred stock. At the bottom of the waterfall is your common stock. Every one of these little pools, every one of these stops on the waterfall has a defined pool where money stops and fills. And then the next money cascades down to the next lower point on the waterfall. It's only at which point you get to the bottom that common stock gets anything. Only after the interest on the debt is paid. Only after preferred dividends are paid. Only then do they get to start wetting their beak at the bottom of the waterfall. But they get all of it. So whatever gets to the bottom, they get to drink. And if nothing gets to the bottom, they die. It's kind of like the circle of life. Common stock, they have the voting rights. They take most of the risk. Again, if you think about this idyllic waterfall at the bottom, they control it. But if there's nothing at the bottom, they get nothing. So they get the right to vote on the directors. They get the right to vote on various proposals like mergers, acquisitions, divestitures, who the auditor is. They've got the ability to be able to control what's going on in the firm. As a practical matter, how much control do you think an individual stockholder has? Practically none. Who owns most of the stock in a company? If you look at one of our local stalwarts, Boeing, who do you think owns most of Boeing's stock? Are your employees, mutual funds? The first investor. In Boeing's case, mostly institutional investors will own Boeing. That's going to be a combination of mutual funds, pension funds, hedge funds, essentially institutions that manage money for others for the benefit of others. And so Boeing is generally controlled by a bunch of banks and other financial institutions. They have the voting interest. When you take a step further, your next largest group of folks tends to be the insiders, your employees. Individual shareholders tend to be kind of, there's not a lot of them, there's a lot of them out there, but they kind of have small blocks, 100 shares, 200 shares. When Boeing's got 250 million shares outstanding, you don't really move the needle. The other important thing to keep in mind when we talk about control of the firm and voting rights, this sounds great in theory and in practice, and I think I discussed this in the first class. Really, the control of the firm rests with the board of directors, and that board of directors tends to appoint itself. So you've got a board of directors. It's founded. You got the founders. The founders get their buddies, and they become the board of directors. Then they issue some more stock. They pull in some other buddies. They might pull in some investment bankers, some of the institutional investors, and other bankers. Those folks go reach out to get their buddies when there's vacancies on the board of directors. Pretty soon, essentially, that board of directors is pretty much a homogenous group of relatively well-educated, relatively well-off white males that run most of these companies. And because most of the companies, the voting rights around those companies are controlled by the same people who made up the board of directors, the ability for an individual shareholder to affect change is pretty limited. And it's designed somewhat to be a good old boys club where they make it difficult to have change, because it's a pretty good feathered nest that you've got. If you're sitting at a public company making $1 million, $1.5 million a year, you've got limited downside and limited scrutiny on what you do. The biggest impact that will happen is when stock price goes down, because then those institutional investors get mad and they start calling for heads-on pitchforks. If the stock prices don't go down, or if you're running at least equal with the market, they tend to leave you alone. Being in a public company is not a bad spot to be. Preemptive rights. Essentially, preemptive rights, because you have control and because you have this priority to assets, if there's additional shares get issued, so companies growing rapidly, you go, okay, I'm going to issue more shares. And let's say I own 30% of the company right now. The other 70% says, okay, we're gonna issue some more shares. We're gonna issue 20% more shares. A preemptive right says I have the right to buy enough of those new shares that are getting issued to keep my 30% share of the company. So you can't forcibly sell these shares out to somebody else without at least letting me have the right to buy them before you sell them to somebody else, so I can keep my 30% share of the company. Any questions on those characteristics of common before we hit the two types? Classified stock and founder shares are related. And these also used to be far more common back in the 40s, 50s, and 60s. It kind of went away. The New York Stock Exchange actually began to prohibit classified shares. And then they've come back. And they've come back for the same reason that preferred shares have come back. Essentially, classified stock, and I'm going to give an example that is a little bit arcane, but classified stock is one that used to be relatively common, and the company that was most famous for use of classified stock was General Motors. So General Motors had three types of three types of common stock. They had General Motors, which was all of General Motors. And then they had GMH, which is GM Hughes. And so when General Motors went out and bought Hughes Aerospace, they said, oh, we're going to have a new classified common stock. So if you want to invest mostly in Hughes instead of in General Motors, we have GMH. They have one vote too, but about 30% of the company is Hughes, and so we're going to make 30% of the stock GMH stock, and you can go buy GMH. And then they had GME, EDS. So for those of us who are old enough to remember this wacky dude, Ross Perot, ran for president in 1992. He made a boatload of money because he sold EDS to General Motors. Then when General Motors bought EDS, he said, oh, there's 20% of the company's a computer company. So we're going to have GME stock. And so you had these three classifications of stock, GM, GME, and GMH. They got different proportions of profit. They each had one vote. They got different dividends based upon the performance of the underlying businesses. And you had a weighting toward Hughes, toward EDS, or toward GM as a whole. Not that common. No pun intended. Not that common to find. Founder shares are shares that are essentially, you issue common stock. Let's say I'm going into business, and I found a business, and we'll call it Ed's Weed and Feed. So I'm going to have a 502 shop and a Subway next to each other. It's going to be my weed and feed, and I'm going to get this thing all built up, and I've got this great company going, and I decide I'm going to bring in some investors, and so I bring in 3 of y'all. I go, look, this weed and feed is going great. You guys want to invest. And I'm going to let you guys be common shareholders in everything. You're going to share in all the profits, and you're going to get, we're at the bottom of the waterfall, and it's just gushing, and it's going to be wonderful. But I ain't going to let you vote. I want control because it's my weed and feed. So I'm going to have founder stock, and that founder stock is going to rest with me. And you're not going to be able to vote, but you get all the other benefits of common. This is what you tend to see with some companies that are in the tech world where the founder shares might have multiple votes. So you got 3, 4, 5 votes per share for founder shares for control purposes only, but economically they're treated as one share. Any questions on these two things? They're kind of edge case stuff. You're not going to see it all that often. I'm not even going to dive into ADRs and foreign equity. You can read it in the book. The easiest thing to remember with ADRs is it's a way for you to trade foreign stock on the New York Stock Exchange in dollars. So you'll see a bunch of companies like Novartis will have ADRs, and they're essentially Novartis stock traded in the US. And I think at this point, I'm going to break it because we now start diving into math, and it's gonna be a little bit of a mind blow to make that kind of change for 4 minutes and then dive back into math again on Friday. So, anybody have any questions? Yes, sir.
Does stock have like transferability statute written into it?
Good question. If it's publicly traded stock, of course, it's generally freely transferable to the extent that a market's made. A lot of private company stock, you'll have a stockholders agreement, which will limit or eliminate your ability to sell the stock without the consent of either the board or other shareholders of the company. So that way, if I don't want you as a shareholder, because it's a small, closely held business, I don't want you as a shareholder, I could block you from selling it, from him selling it to you with reason. Any other questions? Okay, I will see y'all on Friday. Okay. You guys are like the wandering minstrel. I heard your billings is gotten shifted back here too, and down to Chehalis and
all kinds of crazy stuff.
Okay, yeah, just keep me posted. I know you guys are a little bit nutty right now.
Will do.
Yep, thanks.
Yeah.